Hey guys, Tony here. Thursday, July 11th, and I want to take a minute of your time to go over two new filings from Cinemark related to their debt that dropped on July 9th. One being a tender offer for some existing debt, the other filing being the issuance of some new 2032 debt. If you are invested in any movie theater stocks, be it Cinemark, IMAX, AMC, this is probably going to be of interest to you. Stick around for just a minute and let's go through the details. Cinemark is currently trading at $21.59, up about 61% from its lows in the beginning of 2024. On Cinemark's most recent 10Q for the quarter ending March 31st, 2024, they had $3.7 billion in long-term liabilities. We're going to break that down and talk about the debt portion and what changes they made this week. Keep in mind as we're talking about Cinemark that for the year 2023, they booked a profit of $188 million net income. And if we break that down to a quarterly basis, 3 out of the past 4 quarters have been profitable net income wise for Cinemark. Of those long-term liabilities that we just looked at on Cinemark's balance sheet, just over 1.1 billion of it is related to lease liabilities. We don't typically really count that as debt. So we're going to talk today about the long-term debt. And I have a couple of them highlighted here. We're going to talk about which ones changed with the new 8Ks that just dropped this week. Notice here at the bottom of this table in blue, 2.4 billion of that long-term liabilities on the balance sheet is actually long-term debt. Or any company, I would caution you when you're just doing a drive-by on a website and you see long-term debt, $3.7 billion, make sure you dig into the latest 10Q and understand if they have lease liabilities, because most of us don't really consider those debt. You've got to pay your leases, but the accounting rules make you count them as a long-term liability. Don't make the mistake of considering those debt. Go to the 10Q and pull up the long-term debt table to understand what portion of those liabilities are actually debt. That goes for any company that you're looking at. Getting to the debt table that they have here, let's talk about the one highlighted in green first. $150 million of 8 3/4 notes due May 2025. There is a footnote here in the latest 10Q that they did redeem those on May 1st, 2024. So we can cross these off the debt table. Those are no longer a liability of Cinemark. I want to come back at the end of this video and talk about the debt highlighted in yellow, $460 million convertible senior notes, convertible into equity shares of stock. We're going to talk about that at the end of this video, but let's talk about the one in pink that is related to this week's 8K, $405 million, 5.875%. Senior notes due 2026. In this week's 8K, the first of two that we're going to look at, dated July 9th, the company notified those bondholders that they have commenced a cash tender offer to purchase any and all of the outstanding 5.875% senior notes due 2026. In the details of the 8K down at the bottom, if you click through, there is more details about this cash tender offer. It says that it is going to be an offer to purchase by reference to the fixed spread. I have that in green here, the 50 basis points, plus the yield based on the bid side price of the U.S. Treasury reference security above. That reference security being the one here in the table in yellow, the 1 3/4 U.S. Treasury due March 15th, 2025 at 10 a.m. on July 15th, 2024. A lot of fancy talk that you probably don't care about that basically just says, hey, we want to buy out your bonds and give you a little bit of extra if you will sell them back to us early. If you are an investor who buys these bonds and you planned to hold them all the way to maturity and just collect the coupon rate or the interest payment, which is 5.875% on these particular bonds, that would be one option. Sometimes bonds are callable, which means the company can call them back early, and that does exist on these bonds. Company, when they set up the bond, sets up the conditions under which they can call them back and what they are willing to pay if they call them back early. The third option is for the company to do a tender offer, a cash tender, which is what we have here in this 8K. And this is a voluntary thing compared to when they call the bonds back. You don't have a choice. All the bonds are going to be called back. On a cash tender offer, if you want to accept these terms, then you can sell your bonds back to the company. And if you don't want to do that, if you just want to hold them to maturity or see if the company will execute the call option on those bonds, then that's something that you can do also. So $405 million, some of those, maybe all of them, will be tendered back to the company. We will just have to wait and get an update from the company. These bonds have been trading recently at par value, and so the company is wanting to retire this debt early. Why are they wanting to retire the debt early? That goes into the second 8K that released this week. So let's pull that one up and take a look at it. In the second 8K released this week on July 9th, we find that the company has priced an offering of some new notes due 2032, $500 million aggregate principal amount of 7% senior notes. Essentially what we have here is the company wanting to do a cash tender on the $400 million or so of notes that are coming due in 2026, pull those back, pay them off, and issue this new $500 million note. If they get full participation on the cash tender offer and pay off all $400 million or so of the 2026 notes, and with these new notes being $500 million, you can kind of do the math. They'll have an extra $100 million of liquidity to play with on their balance sheet. In summary, what we have here is the company taking a 5.8% note due in about a year, due in 2026, rolling it all the way out to 2032 at a little bit higher rate, but taking off all the pressure of having to pay that in 2026. This is a great template for potentially what a company like AMC could do if the box office improves and the stock price of AMC goes up along with that. Being able to roll debt out, even if it's at a slightly higher rate, roll it out to a much later date so you can deal with it at a later time when things are better. The final thing that I want to talk with you guys about with Cinemark is what I have highlighted here in yellow, the convertible notes. Now, these notes are not part of this week's 8K, but they are worth knowing about with Cinemark because I do expect that these notes will be converted at some point into common shares, acting as dilution, which will affect common stockholders of Cinemark, yet improve Cinemark's balance sheet by taking $460 million off of the liability side of the balance sheet. If you've been paying attention to Cinemark, the short interest of Cinemark is almost 25% short. You might be asking yourself, why would a company that is profitable like Cinemark going into a better box office the second half of this year into 2025, 2026 be 25% short? And that is a good question. It most likely has to do with the way that the holders of those bonds are trading the arbitrage opportunity of the convert on those bonds. So you might watch for an opportunity as all of this plays out. If Cinemark takes a big dip, to expect that the conversion and some dilution is going to happen. And if you were interested in buying some Cinemark, that might be something to look out for as a potential buying opportunity. I personally don't hold or don't plan on buying any Cinemark, but if you are interested in trading it, that might be something to keep an eye on. Know that those converts are out there. Know that there's going to be some volatility in Cinemark's price. I think that is worth mentioning because as you see analysts and mainstream media pumping out higher stock price targets for Cinemark, $23, $24, $25, $27, they aren't mentioning the potential of dilution due to those upcoming convertible notes. And I think that is something that you guys need to know about if you're thinking about trading in Cinemark stock. Now, you guys know I am not a bond expert, so if you are a bond expert and I got something materially wrong in this video, feel free to drop some comments down below. I have spent 30 years avoiding having to learn all this sort of nitty-gritty about bonds because I mostly have traded in profitable companies. But over the last couple of years, as we experiment with some of these short squeeze plays and non-profitable companies, I've been dragged kicking and screaming into finally learning everything possible about bonds. When you're trading in troubled companies or not profitable companies, understanding the balance sheet, the debt on that balance sheet, and the struggles that management has to go through to manage that debt, manage dilution, manage equity raises. All of that, guys, becomes very important to me and to you. You cannot avoid learning about this stuff. Now, I know I've seen one or two of you that don't want to learn about this stuff, and that's fine if you don't want to. Just stick to investing in profitable companies, and you don't need to worry about becoming a debt or a bond expert. But if you want to continue to dabble in short squeeze plays and non-profitable companies, or even some of you, companies that have zero revenue, then I'm going to keep encouraging you to learn to read the financial statements. Look at that income statement. Are there a bunch of negatives there? Well, if you hold it long enough, you're probably going to be diluted or have to deal with the Chapter 11. How about that balance sheet? Is the liability side bigger than the asset side? You better understand what that means, because you're likely going to be diluted or have to deal with the bankruptcy. How about the cash flow statement? Is there a positive or negative operating cash flow? How does the bottom of the cash flow statement look? If you don't want to learn about that, then don't be surprised if you get diluted or the company files Chapter 11. All of these things, guys, matter if you're holding troubled companies long enough, and you can't avoid learning about it if you want to dabble, speculate, gamble, invest in these companies. When we avoid learning about these things and then bad things happen that we're not happy about, the temptation becomes blaming others, especially blaming management, when really management is doing their job to manage the liquidity of the company and try and avoid Chapter 11. If those things like dilution and equity raises piss you off, and I understand when they do, make sure you understand the financials before you invest in a company. If you don't like those things, do not invest in troubled companies. Stick with ETFs, stick with blue chips, stick with profitable companies. I hope that you found this little chat on Cinemark helpful. If you have other questions or comments, drop them down below. I love to hear from you guys. I am Tony Denaro, and I will see ya on the next video.